Faire bifurquer nos sociétés et les entreprises va coûter beaucoup, beaucoup d'argent. La transition a un coût bien moindre évidemment que celui de l'inaction, mais on a le droit de se le dire, ça va coûter un pognon de dingue. La finance doit donc changer de rôle et ne plus se cantonner au financement d'activités profitables. Mais alors, comment les acteurs économiques peuvent intégrer les critères ISR et accroître la valeur sociétale des entreprises qu'elles financent? C'est la question de notre prochain panel qui prendra aussi les vôtres, si le temps le permet, pour poser vos questions. Il vous suffit d'aller sur slido.com, slido.com, et d'entrer le numéro de la session, numéro que vous retrouverez juste ici et qui s'affichera tout au long de la conférence. Vous pourrez poser directement vos questions sur l'application. Je me ferai votre voix après. Dernière indication sur cette session, elle va se dérouler en anglais si vous le souhaitez. Des dispositifs de traduction sont à votre disposition. Ceci étant dit, I now leave the floor to Gianmarco Pannone, Investment Manager at the European Institute of Technology, and all his guests. Gianmarco, the floor is yours.
So thanks, welcome everyone. Thanks for being here today. So today, the session of today, it's an honor to host this session because we're going to talk about a topic which seems a controversy, because we're talking at the same time about finance, which historically has, let's say, awarded short-term return and a long-term impact, with an environmental situation that is, let's say, becoming always more worrying, with the climate crisis, the destruction of the biodiversity. We have to step in, we have to act. At the same time, as also EIT New Energy, we saw in the press the Norval case, things that big European champions that is struggling to meet the milestone achieved. So I mean, we're gonna use this panel to gather both the private, entrepreneurial, and public sector to discuss. So maybe a quick round of presentation, and then we can start.
Hello. Do I start? Yep. Hi, everyone. My name is Marta. I am a co-founder and co-CEO of Pebble. And what Pebble does is that we turn CO2, the gas, into a carbonate, so a rock, and then we turn the built environment into a carbon sink, such that buildings can become carbon stores and our built environment can become a climate solution. That's what we do. We're called Pebble. And my background previously is I was an investor, so I think I kind of carry both hats here.
Hi everyone, very happy to be there. I'm Mathieu Garnero. I work at ADEME. It's a French ecological transition agency. I am head of economy and finance subject and a specialist in sustainable finance.
So hi, I'm Marie Eklund. I'm the founder and CEO of 2050. I've been a venture capitalist in the digital space for 20 years until I realized the true transformation we were living is sustainable transformation, and that the venture capital model, historical venture capital model, was not gonna fuel that transformation and neither accelerate it nor enable it. And so I've built 2050 as an answer to how the finance industry could be modeling solutions to be able to finance it at best.
Bonjour, my name is Pia, and I'm not only an angel investor, but I have the pleasure of also being the board member of LUT University in Finland, which is number 10 in the world in the universities when it comes to UN Sustainable Development Goal number 13, climate action. So it's really in the core of our university that we've been doing this for a long time already and getting great innovation out of it. For example, Solar Foods, which was just listed 8 weeks ago at Helsinki Nasdaq First North, making food out of thin air. But also, like 8 weeks ago, I still worked for the Finnish Government Fund, which is a part of all the Finnish government's innovation activities. And I think that will also be part of the experience I will be using in this panel.
Great, thanks a lot. So maybe you can start from the beginning. What is systemic finance, and I mean, how do we tackle, let's say, today top challenges? So maybe Ari, I'm gonna start with you. Let's say, as an investor, let's say, focused on systemic solution, how do you define the role of finance to, let's say, fight those interlinked global challenges we face today?
Yeah, I think finance is quite unique in the fact that we all know that the challenges we're facing are systemic. And there's only 3 places in the professional world where you can actually have a systemic impact. The first one is politics. Second one is media or education, where you can actually think and build around systemic solution. The third one is finance. But when you're in one particular industry, you cannot act on the others, where finance can. So that is the first reason that I believe finance is so important, that it can actually act on understanding what are the systemic problems and how to act upon all along the value chain and be able to have it shift. The second reason is that not only finance can act at a macro level, but it can also act at a micro level, meaning we are supporting companies and building best practices into the governance, into how to make decisions at a board level, into how to value company, what good looks like for companies is mostly defined by finance. So in a world, for me, where if you're going from digital transformation to sustainability, basically what you're doing from a financial perspective is that you're stopping valuing companies only on finance, but you're adding 2 other dimensions, which is environmental and social performance. And if the finance industry doesn't take that into account into how they value companies, it's going to be really hard for the companies to change, because one, they will not have the means to do so, and secondly, they're not going to be rewarded for the efforts they're doing, neither from a performance perspective nor from a risk understanding, because we always tend to forget finance is not only about performance, it's also about risk and reward. And so today, I believe us investing in sustainable companies is not only optimizing triple performance, so environmental, social, and financial performance of these companies, it's also funding companies that have reduced risk, that are resilient, and so that are building basically the best risk ratio reward. And the role of finance is not only to think systemically, so to understand what are the key problems we're facing, and this has to be science-based, but on top of that, to build the best practices at the company level so we can actually guide them and support them in their alignment on triple performance and build these best practices at the company level as well.
Great, thanks a lot, super insightful. So Pia, now both for you. From a public perspective, I mean, how do you think public investment can pave the way for long-term scalable solution?
Well, that's what the European Union and European Commission has been, for example, trying a lot and succeeding partially as well, but that's not enough. We need to also have national initiatives, we need to have local initiatives for this transition to happen. And I don't want to bring this early in the panel, but let's be realistic. We had a potentially quite unfortunate voting result in the US. We've had the war on green investments between USA or North America and Europe, by the way, which should be good for the planet, that we are actually competing here. Who can invest and substitute more, or how would they ever put it? But the role of the public funding, to me, and with my 5-year experience, is that first of all, the government or the state doesn't pick up the winners. The government doesn't choose the technologies. One question, for example, was and has been to many public entities until very recently when it comes to sustainable and green in financing is nuclear. And we see very interesting solutions in SMR sector for example. And this could be like, yes, we love the initiative. I mean, great science, it makes sense. However, we are not allowed to invest in nuclear. So I think these matters we need to do and do some reconciliation. And I think the government should be neutral, you know, technology neutral. But when we are, you know, ease with that, so state doesn't pick up the winners, the state doesn't choose the technologies. So then we can foster and we can be the patient investor and yet get the money back for the taxpayers with interests. So how we operated, for example, with Climate Fund was actually not going with equity because many companies didn't like having a state of Finland in their cap table. I'm not taking a stand here now what the France Paribas is doing, not at all. But on the other hand, you know, like with equity debt, our customers loved it. And on the other hand, I can assure you that as I said, Solar Foods not only is coming from Lund University and VTT, the Nordic largest research organization, but also it has been in the Climate Fund's portfolio. So I mean, you can get things listed, and the balance is kind of there, and we have to be fair, and we have to be kind of doing things long cyclically, and we have to also earn the trust of VCs. And we did a lot of footwork for that, and we learned a lot. And by only doing it together and seeing like that it's an ecosystem where you also need patient money, like the governments can provide. So that could or would, or I saw it working quite nicely.
Great, Pia, thanks a lot. So now let's move to what are the barriers here? I mean, what is blocking to adopt, let's say, a long-term sustainable financing solution? So Mathieu, maybe for you, since at ADEM you're, let's say, working for a public institution, also extremely correlated with private investors. So with what you witnessed so far, what are, let's say, the barriers, cultural, market-based, or let's say in terms of regulation that are holding back the adoption of this kind of long-term financing solution?
Thank you for the question. In my response, I think I will have a mix between barriers and levers, because some barriers are already removed, and maybe when we look at the levers, we can have a discussion with the barriers. So the first aspect is there is the question of transparency. If we want to take into account E, S, and G subjects, we need to have no asymmetry in information between companies and investors. And for example, in Europe, with a new regulation like CSRD, there is the removing of this barrier with a lot of information. It's mean a lot of work for financial institutions to analyze those data, because we talk a lot about all the work that companies has to do, but it's also a work for financiers. So first one, the transparency. Second one is to link financiers with the problematic of real economy. What are the subject of decarbonization at sectoral level? The topic is not only to reduce GHG emission at portfolio level. This has no meaning. The question is to know what are the mature technologies, what are the research and development at sectoral level, and what can be done. And when we look at a disruptive approach, it's not only technological part, but in some cases there is a question of the use instead of the possession of objects, and the question of circularity of economy. So there is a lot of subjects that the investors has to think about. Third aspect, and this is the question of company level. And so there is a need to have a sectoral view, but there is also a need to have a precise analysis of the company and what is the company doing. And what is done currently, it's the subject of categorizing companies. So there are companies that are providing solution, that are aligning company, and not aligning company. And how to look at that? You have to have an analysis of the transition plan of the company. And this is one of the aspects of the CSRD. So investors have to introduce a capacity of analysis of those transition plan. And I think on this aspect, it's more a work in progress. So some aspects are already in the analysis, like the target setting, climate target setting for companies, or like the governance. Is it an appropriate governance of climate subject within the company? But there need to be a detailed analysis of what are the means, financial means, human means, the different levels at company level, and this is a way to have a correct dialogue between the investors and the company. So to look at what really to be needed, and not only the target and the governance, because it's too light to be sure that what has to be done will be done. And regarding this aspect, it's important to have in mind that with CSRD, it's really different than NFRD before, or DPEF in French. It's not a backward-looking approach. It's not only past emission and what has done in the past by the company. It's more a forward-looking approach. So what is currently the company foreseeing regarding its future investment, its way to decarbonize. So it's really important to have this this view, and to have a look at the barriers. I think as a member of an ecological transition agency, and to be a bit provocative, I like barriers. In fact, to do some transition, we need some new barriers. And for example, when Europe banned the selling of thermal vehicles, it's a barrier, but it will provocate a lot of electrification, the research and development, the development of recharging. So yes, there is a barrier can be very helpful. Another example is for the ISR label in France. There is a barrier for the development of new fossil fuel project. And I think in this case, a barrier can be a good solution for transition. So in some cases, we need barriers. And last point is the incentive. So not only barriers, we also need incentive to have a solution. And we have made a large work at ADEM regarding what can be done in EV industry, for example, steel, cement, chemistry. And for this, we need, in each sector, to decarbonize what is produced in France, between 1 billion and 10 billion in each sector. We have a solution for electrification extra. It's not, it's quite hard to abate, but it's not, there are some possibilities. But we need investment, and even if we make this investment, the green steel, the green cement, the green ammoniac extra are twice costly than not green. So it's not only about capex, there is also a need about opex, and so we have to solve those both aspects. So we have some technical solution, but it's more costly. And ADEM, as a state operator in the context of France 2030, France 2030, we provide some funding to company to decarbonize. So it's a real good help for capex. But there is also a need for a demand for this green production, and there is a question of the OPEX help. And in some part, what is done at European level with the ETS market of carbon can help to rebalance the difference between the green product and the brown product in those sectors.
Great, thanks a lot. Now, last but not least, a former venture capital investor that decided to join the bright side and become an entrepreneur. And I mean, after hearing, what has been said during this panel, what, let's say, in your experience have been barriers, and how do you, let's say, present or translate those, let's say, long-term impact, especially operating in clean tech, as a trade-off for, let's say, instant return or short-term return with your potential investor, new or potential?
Thanks for the question. So Marie is an investor in Pebble, my company.
Very proud investor.
And for us, it's quite simple. We were very fortunate to partner with 2050, which is an aligned investor. What that means is that always when you make an investment, and this is my experience from having been an investor as well, is that you set an owner agenda, so to speak. Once you have come in, hi Ben. Once you have come in as a new investor, you join the board typically, or whatever governance form you have, and then you say, this is what we're going to try to accomplish together. You typically have a 90-day plan or a 180-day plan, and during this, you set the agenda for what needs to be done to reach the next milestones. For us, what that looked like was actually having a full alignment workshop, not just one, a whole process around it, to make sure that whatever targets we set for the company for the first year, second year, fifth year, 10th year, whatever, would guide us towards our 2050 target. And our target as a company by the year 2050 is to restore the planetary carbon balance by a gigaton of CO2 or carbon by then. If you ask my co-founder and co-CEO, he'll say that for each year, but I'll be happy if we just reach the first gigaton by then. That would be amazing. And what that means is that every single decision that we make, we always look at, is it taking us closer to our goal in 2050? We don't know what the world is going to look like 10 years from now or even 2 years from now, but it creates a compass. So that's one thing I'll say. From a governance perspective, it's vital to partner with folks that are going to be helping you think long-term and also steer your company long-term, because everything that you're doing in industry, you're putting steel in the ground. Those facilities, whatever you're producing or you might be producing already, the steel is going to be in the ground for at least 30 to 50 years. In some cases, those production sites are going to be there for well over that. And you want to make sure that you're aligning the interests of the planet with your own interests from the get-go. I think it's the only way to do it. Now, from an investor perspective, this means that you need to be really brave with regards to weathering the storms. And this, to the question that I think Pia was asked, what is the role of the public finance? I believe it is. I've believed this during my years as a venture investor, and I certainly believe it now. It's to fill the gaps in the innovation economy. It is not there to be competing against private investors, and thank God mostly this is not happening. It is there to fill the gaps. For as long as there are gaps until the market is allowed to do its thing, or the laissez-faire can do its job, it's there to support. I think we're going to talk about Northvolt maybe in a second. What I will say is that the amount of state subsidies that exist in places like China or the US for the green transition are orders of magnitude bigger than what we have here in Europe. And I think it's an existential crisis for us here to figure our stuff out in terms of not just the immediate green transition, but actually millions of jobs that are at stake. I'm not sure I answered your question. I can't even remember what the question was, by the way.
No, absolutely. Super insightful. There was, let's say, also to have, let's say, all of you, your point of view, your insight on your specific sector. Now, I want to, let's say, to think together. I mean, each of you, can you tell one of, let's say, one public-private initiative that you believe is successful and the impact it had on, let's say, financing those long-term projects? Maybe you can share with InnoEnergy. I mean, we're proud to have invested. We invested on a PowerPoint for Norvolt, and it was been impressive what they've been able to achieve. And we're keep doing that with Vercor, the French Norvolt, with Gravitae for production of green steel in France, and we're pushing. I mean, we need to take risk. We need to step in to let's say, fill the gap that sometimes is not filled by entrepreneurial initiatives alone. And I mean, let's say, we're working together with EIB, with EBRD, with ADEME, with all the actors, private and public, to, let's say, find a tailor-made solution to finance this kind of giga-scale project in Europe. But I mean, let's say, on your, from your point of view, I mean, what has been some, let's say, classic case that you witnessed so far that is successful and need to be repeated or implemented in a more broader way?
I can start. China investing $230 billion, I think, per annum or something ridiculous for the EV industry there. Yeah, I'll leave it at that. By the way, China is now at a 51% EV penetration on the markets of that size. It was at sub 10% a decade ago. The subsidies are the main reason it worked. And that's, by the way, why there's also dumping on our market here in Europe as well. But from an economic perspective, it certainly did the job.
So I'm going to give, now that Marta gave the macro example of what worked to really change a whole industry, and I fully agree. I'm going to bring a micro example, which is Pebble. Because I think it's very relevant to what we need to do as a overall financing of the value chain shift. So my perspective on the sustainable transformation is that it's very different from the digital transformation in the sense that you could digitalize yourself at a company level through the digital transformation. You put a website, an e-commerce site, so you can sell directly to your customers. You put AI in or productivity tools internally, so you can be more efficient and more profitable and build the margin and be competitive. But then you can have a digital transformation at a company level. For sustainability, it's very different because you depend on what your suppliers are doing. If they don't change the type of materials or the way they do logistics, your carbon footprint is not going to decrease. You depend from your customers. You depend from what they're going to do with your product, how the whole recycling stuff is happening, the way. So it's a value chain shift. You cannot sustainably transform yourself alone. So there needs to be some thinking about how the finance industry moves the value chain shift and allow it to happen. And and this was really at the heart of what Pebble was doing, because that means it's not going to be about disruption, it's going to be about evolution. And we need the big guys to change and to be part of that transformation as well. So when fundraising the Series A for Pebble, it was clear that we actually needed the value chain to be part of willing to have Pebble becoming a success. And so in the Series A, we deliberately dedicated 40%, or I can't remember exactly what it was, so a significant chunk of the fundraising to actors from the value chain, so cement constructors or end users or construction companies. So we have three major actors of that, a family called Goldbeck, which is in the construction industry. We have Holcim, which is the biggest European cement player, and we have Amazon Climate Pledge Fund, who has already committed to use Pebble's material to be at the heart of building their new data centers to be carbon negative. And so this is how, from an even financial perspective, you can bring and build new alliances that are making the whole value chain have interest into making this shift together. And I will just add that what we see, we're looking at the oceans right now because it's so key in the transformation, and that all the ways to fund ocean projects in a very successful way, a lot of them required blended finance, where we actually need not only equity, I was talking equity for Pebble, but we also will need debt to build the first-of-a-kind plant as well. So we need to build different alliances, not only with the corporate world, but with different actors of finance. And in the ocean, it's going to be not only equity or debt, it's also going to be philanthropy, it's going to be public money. We all need to bond and build a lot more bridges to different types of investment and understand how that works together from both a corporate and value chain perspective, but also the financial value chain as well.
Can I just add something on that? Thanks, Marie, for the shout out. I want to give a shout out to the, where we have our demo plant, our pilot and demo plant in the Netherlands. And we've just received a roughly €2 million subsidy to co-finance quite a large chunk of our demo plant. So this is a fantastic example of where we've first secured private financing. This has been 80% or more of our financing so far. But then the Dutch state seeing what we're doing and supporting it and saying we'll co-finance the steel, the CapEx, has been very positive towards the next batch of private investors that see, yeah, the government is supporting, like the authorities are supporting this. It's not just a private effort, and they're not going to be, isolated to private money. Also releases more private money. So there's actually compounding effects of the public and the private markets working together.
I confirm it's clearly the case of the fund dedicated by France 2030. And when ADEM financed some project, ADEM financed 20% of the project, and the rest of the project is financed by private capital. So yes, it's really a way to have with around 2 billion euros of grant each year by ADEM. There are 5 times more projects that are developed in the industry thanks to this grant by France 2030.
And to get back to your original question, so I thought that, okay, macro China, now great. I'm a great fan what they're doing. I wish they would have done the first one in Finland. I could have done it, but Marta knows about it and you know about it. So it's good that it's the Netherlands. We didn't have off-takers. So anyhow, what we did in Finland in the past tense was how we substitute the first wind energy parks. And it took almost a decade. So, I mean, it was Finland is 5.5 million, but a huge country by landscape. So that was kind of an example of a national initiative, which was, I'm sure it was accredited in EU somehow, and that the same thing was happening in 2000s and 2010, also otherwhere in Europe. But when it comes to this blended finance, I echo very much, and that even comes all the way to Northvolt. You know, what were the learnings when their CFO came to Helsinki to one of our key ecosystem players, their office to tell their story, how they actually raised 10 billion, 12, 11 billion, and
15.
15, yes, and rising. So anyhow, so it's the customers. So what I say to companies always, the best money, of course, is subsidies and grants. You know, not diluting. You don't never need to pay back. But the very best money is, of course, from customers, because that brings credibility and that brings revenue. So first customers, then subsidies, grants, whatever, then lending. And of course, the most valuable money is, of course, the equity, because that would then dilute you. But then when we did a study in the Nordics, I was in a group of Nordic Innovation and a great Swedish research center, RISE, and we were discussing about the challenges in circular economy, you know, and how do the old structures in finance not actually get it, you know, when the models are going towards sharing, co-sharing, leasing, renting, and how to build products in the classical banking sector. I mean, we can buy EVs or whatever vehicles as leasing, as even, you know, as companies, corporations, employers, but also employees. And one example was, this is not working, but like, was it 4 years ago? There were the electric bikes became very popular, and the Finnish employers wanted to, for the sake of the climate, for the sake of getting more people doing physical motion, people are aging, people are gaining in weight in Western world and also in Finland. So there were a lot of companies, a couple of them are already here in European markets, that came up with the, you know, how to lease electric bike and make it as a productize and run it all and maintain it and make it lucrative for the employee to buy it after 3 years, etc. You know, the leasing model. But the banks, for example, my alma mater, Nordea, the largest bank in the Nordics, didn't get it. That they said that we can do this for a car. We've leased cars and fleets of cars for 30 years, but you know, how to value an electric bike, and the price point of an electric bike is still somewhat lower than a car. So they needed a new instrument. Okay, it took some 18 months for you know, commercial banks to understand that, hey, let's build these models and build these kind of funds or assets. The same goes with what we did at Climate Fund was when it came to energy storages for households. So also, you know, bring up the leasing model. So there was an infrastructure fund called, and it's existing, Kaktuk's infrastructure fund. So they actually understood that they have the software, they have the service, they have the technology, they are evolving it all the time. But because they can't, their balance sheet doesn't make sense for them to buy the. Where they started with reused Tesla batteries, and now they have a fleet of very interesting battery technologies. But as of a whole, so we need the change in the circular finance thinking and new products to be evolved in very classical banking, as well as then with funds. So we need a variety, because the VC market is still in transition, even though we have great 2050 in understanding that there is a CapEx component in climate tech.
Great, thanks a lot. So, of course, I mean, building on what I just said, I mean, first is that product market fit is crucial. I mean, you have to prove that you're valuable, that somebody wants at the end to buy and use your product, and then cash is king. But as Pia was saying, the market, the VC market has been a bit dry this year. I mean, we all know the factor that, I mean, brought more liquidity towards the beginning of 2020, and then a bit less starting from last year. What do you see? I mean, so then there's the equity component that could be at some point lacking, and even if there are, let's say, initiatives such as the Innovation Fund or the IC investment at different stages, plus all the national financing. But how do you see the collaboration between, here we have the three worlds, the entrepreneurial world, the public world, private investor. How do you see the collaboration between, let's say, those three categories of those three actors could, let's say, foster systematic change for sustainable finance?
I have the most key thing which works quite well in, well, I'm sorry to brag about, but in the Nordics is trust. Trust that the state doesn't mess up the market. Trust that you will get your money back even if you are under a very tough European banking legislation, so that you know, you can, as a bank, you know, with EIC guarantees or EIB guarantees, that you bravely go to the capex heavy startups and you know, with the bankers in conventional sector, you know, not in alternative asset class, trust. And then also, of course, that we keep the substitutes and grants in a way that nobody's misusing them, that there won't be fraud. But for me, it's trust.
I have another word, it's connection. In fact, in the context of ecological transition, everyone has to do some planning of the transition. So states are doing planning. Currently in France, we are doing the SNBC3, for example, National Low Carbon Strategy. Companies has to provide their transition plan, and also large financial like bank have to publish their transition plan. And there is the due diligence text at European level, and it will be an obligation at 2025, for example. So everyone has to plan, and there is the question question of this connection between all those plans, and there is the question of the value chain and scope 3. For many companies, the question of their emission and their strategy depends on other actors, furniture, for example. And what we have done at ADEM since quite a while now is to have a methodology that is called ACT, and that help companies to build a transition plan. So what are its targets, what are the levers, what are the financial needs needed, what is the governance. So ACT, step by step, help companies to define a transition plan. And the other way to use ACT is ACT assessment. When you have a transition plan, it's a way to assess the quality of the transition plan. Is this transition plan compatible with a climate neutral economy, for example? And an example of success regarding that is, for example, we have a deal with Carrefour this year. Carrefour is a large distributor for many things, and to decarbonize, Carrefour has to change the carbon of the furniture. And in this context, Carrefour has decided to have an engagement with its 100 more emitting contributors and use the ACT methodology in the assessment part for the large companies like Coca-Cola, Extra. So for large company, it's an assessment of the compatibility. And for the smaller companies, it's ACT step by step. So to help companies to build a transition plan. And also when you have this transition plan, you can discuss the way to improve. And in some cases, maybe Carrefour can done some work to change the products that are exposed in the stores, etc. So yeah, there can be a link between two. And we have also an example in finance of Act for Climate. So it's Fideas, it's a small asset manager. And they decided to invest in 20 mid-cap with a dialogue with the top management of this mid-cap. It's a 5-year investment. And they decide to accompany those companies to have training regarding climate, to have a diagnosis of their emission, and to set a transition plan with the ACT step-by-step methodology. And they expect that with this accompany, during the 5 years, at the end, the company will be a company ESG investible. I don't know, it's in English, investissable, and so to have yes, financial gain of this investment.
Great, right. Something to add, maybe the bottleneck. I mean, from your perspective, I mean, you see all the stages in which, let's say, startup they reach the first grant, equity investment, then they need to step in for venture debt, classical debt, and so on. What's your feeling, and what have you witnessed so far that's blocking the way, or there's a bottleneck at a specific stage?
For me, the main bottleneck is how decisions are made. And I will be a little bit more explicit about that. If you take finance example, but I believe in most of the industries, it's the same. The way decisions are made is by looking at past historical data. So you look at the past, you look at what has worked in the past, and work usually means gaining a lot of money. And you make decisions today based on these past historical data, and you make decisions based on what has gained the most money, which usually is part of the things that have the worst environmental and social impact, potentially. So when making decisions today, and the way we have the best practice today, is about reproducing the past. And I think we will never solve the challenge we have if we continue to make decisions that way, whatever happens. That means in finance, for example, Pia was talking about having new products. We are a new product, which is way more suited to sustainability, we believe, than classic venture capital funds. But the way finance works and the way the decisions are made means that we have no historical past data because it's a new product. So we're unfundable by classic finance in these means. And so for as long as people were not come together and say, this is the future we want to build, and be forward-looking instead of backwards-looking, I don't see a change. And not only will we'll be reproducing the past, we will be overfitting. We will be making decisions that are increasing these problems. And so the main thing for me is about what is our common goal? What is the company we want to build? What is the mission we want to reach in 2050? And therefore, what do we want to make as decisions today based on this compass? We need this at a more broader level around, because people tend to forget that when we're investing, we're absolutely not, it's not a bet. It's not something that has just money in Las Vegas, you know, to see. It's not that at all. We're shaping the future. That's what we're actually doing. We're putting a lot of energy to go that way or to go that way. So what is the way we want to go? And that means we need a common vision at European level around what is the future, what is the society we want to live in 5, 10, 15, 20 years from now? What is the society and the world we want to leave to our children? And if we want to have that compass, then you're asking yourself, if I want to go there, what are the decisions we need to take now to have a chance to go there? Because we know what the problems are. And when we start digging into solutions, we actually have the solutions. Pebble's based on a technology that a researcher has been working on for the last 20 years. We lost 20 years.
No, actually, we lost 40 years.
There you go.
We knew, this is one of the reasons I wanted to found Pebble, is that I found the first research paper that's roughly my age, I just turned 40, that showed how you can accelerate mineralization and showed how mineralization works. 40 years ago. The more I read into this, the more furious I became. I was like, how is this not like the biggest company in the world today, or like the fastest growing company in the world today? And I couldn't really find good enough reasons other than vested interests. And so to your question, how the public, the private, public sector, private investors and private companies need to work together, it's quite simple actually. You need to create a regulatory environment in which there is a fair chance for novel materials and novel energy solutions to get to a market fast. Like a highway, in fact not fair, it needs to be unfairly good, advantageous for new products to come to market. You need to have the private markets that are going to trust that the regulators are not going to come and screw them, pardon my language, which is happening because, hey, guess what? The lobbyists out there from the traditional industry have a pretty strong voice. So you got to hold them accountable. And there's so many undercurrents that are just mind-boggling. So we're very fortunate to be living in an information age. You can show through data how your solutions are actually real. 20 years ago, that was more difficult. It was less transparent. Today, you can do a lot more. And then from the private companies, what you got to do is transparently show your progress. You're not going to win all the battles. You're going to have bumps along the way. If you're just showing a sales pitch or just a rosy picture, you're not going to build trust. So apropos trust building, I have a really hard time with trust building. I think you got to show data to earn that trust. And I think that data needs to be transmitted throughout the entire ecosystem. So finally, my message is you need to create alignment at a regulatory level, at a financial incentives level, because we got to make money off of the transition. That's important in the right way, by the way, not through greenwashing, which I think should be made illegal. Illegal, I'll say that again. But also that the companies that are part of this are sharing the data on their progress, but also where things are hard. Only that will we be able to do this. My final message is that there is a time value of money. Those of us that come from the finance industry know this. €1 today is worth, less than €1 in the future, hopefully. And you need to be sober about how you invest. So that would be my response.
Gianmarco, if I may, because we have questions from the audience,
Yeah.
and one of them actually relates to this idea of creating trust and sharing the right information at the right moment. A lot of people in the audience are asking all of you what your opinions are about the elephant in the room. What top learnings do you have from the Northvolt failure?
Please.
Hey, come on, guys and girls. I understand you summarized. We don't know yet whether it's a failure or a success. I mean, give us a break. I mean, this is not, how do they say? This is not a 100-meter sprint. This is a marathon. So allow me to do that. And then you can start saying, what can we learn from the obstacles so far? Sorry of being so positive today.
Yeah, sure, happy to answer. I think part of the elephant in the room is that Northvolt is partially a victim of the longest bull market we have seen in the history of our economy. 12, 13-year long bull market, super low interest rates, money was very cheap. You could, like a glass could raise millions of dollars in venture funding. And there's part of that is just the state of the market that Northvolt was founded in, and it was founded 8 years ago. So I'm pretty sure that had Northvolt been founded in a less of a bull market, I think the growth story, although it's been super impressive to be able to get that momentum, I think it would be more measured, taking risk on sequentially and not all stacked up at the same time. So that's one of the things that I'm taking away from this, and I have, by the way, a ton of respect for Northvolt and what they've achieved. And I think whoever asked the question, calling it a failure.
That was me. That was me summarizing it. I have to be honest on behalf of the public. That was me putting the long course question in a nutshell.
Right, yeah. So in a nutshell, let's not call it a failure. Let's call it a work in progress and lots of learnings. There's about 5,000 really brilliant, hardworking people working on getting it under control. Okay, and in Europe, we need, like from a security of energy perspective, we need projects like Northvolt at scale. So I think InnoEnergy, thank you very much for being an early partner and also for partnering with them throughout that journey to fill the gaps also. None of this is done before. There's no playbook. Northvolt is writing playbooks for the rest of us. The reason I know my company needs to grow through offtake agreements and through blended finance and how to build a team is thanks to Northvolt.
Yeah, and also from InnoEnergy's perspective, is the key message is we need more Northvolts in Europe. We're going to have Vercors soon in France, and we need to learn to do better, to be more efficient, but that's, let's say, our point of view on the Northvolt case.
We have another question from the audience, which is how and well will mature equity providers like infrastructure funds participate in the energy transition challenge without taking technology risks notably?
All of those who want to kind of be part of this, which I hope the whole room or the whole fair, find a VC team that you like. And, you know, as a larger investor who doesn't have an agile team who is scanning the ideas, old and new ones, I fully echo the climate tech industry is so fascinating that, you know, there are ideas from the 60s that work now. But at least this is my 2 cents. Like there are players, there are teams who've been on the right side, I mean entrepreneurial side, as well as on the VC side. So at least that would be like Europe. Okay, Europe at least is lacking a lot of corporate venture capital type of thinking. I was amazed when I learned, for example, I wasn't educated enough in the other sector, health, that in US, the private hospitals and private healthcare providers, they are also very eager to see these corporate venture capital actors. But I think, like, join, because there are vehicles in Europe and know-how in Europe. We don't need to look at anymore. We've learned the lesson and we know how to build unicorns.
I will add 2 things. One is there's actually innovation in the infrastructure funds world as well. And so I know of funds that are starting now, which are bridging, that are doing both equity and infrastructure, because they know that technology is going to bring what it takes to bring scalable industrialization margins higher and to make it worthwhile. And so I see in the infrastructure products innovation by wanting to take technological risk because they know that's going to be a key to success on the infrastructure part of their business. I also see more infrastructure funds going evergreen, so adding longer term and thinking on what they're doing, like we're doing at 2050. But also, I see the movement towards more blended finance, meaning closer links between venture funds and infrastructure funds, because we have to. And that means there's going to be some innovation on the time horizon of that and how to build liquidity in different models so that investors can be patient, which is what we're working on. So for me, the overall finance world is going to have to move to adapt and be working together, either through greater understanding of the different models or through new types of vehicle that actually blend it within.
There is one last question that I think you can all address maybe, and it's a question about sharing best practices. The question reads, what best practices can you share on the value chain collaborating to decarbonize faster?
I think that's for me, probably.
Well, you do that.
Yeah, so again, reiterating what Marie said, so at Pebble, where we're creating a cementitious material out of CO2, what we are facing is a very slow-moving, conservative, low-margin, highly regulated market. It's like the full cocktails there, and that's concrete. By the way, heavily lobbied through the cement and lime industry, so not making it easy. What we did was to map out our ecosystem, our value chain. So from the cement world sells to the construction companies build for asset managers, asset owners. So we mapped that out, and then we looked at where is the CO2 emissions problem the most valuable to them. Not the biggest, most valuable. Where is it most valuable to solve the problem? And it ended up being at the asset manager, asset owner level, because they're going to be holding those buildings. Just like we have the energy scores that we have A through whatever E or something, we're soon starting to have the carbon footprint of those buildings. And so we understood that there was a lot of shareholder pressure, stakeholder pressure there. So that's where we partner with Amazon and their Climate Pledge Fund for them to be the end consumer demanding that the construction companies, which have no margins, they're not going to move by themselves. My parents come from civil engineering. That's the most hurting part of the civil engineering or the construction world. So there's an incentive for them to move because the end consumer says, we want this. We are creating a financial instrument for them to have some vested interest in this working. And then for the cement world, well, they have to pay ETS. So my ask to the regulators is please increase ETS and keep it consistent and make sure it is enforced such that cement has to pay for ETS come 2027. So there's no changes to that. And then we work with each part of that value chain to make sure that there's something in it for them to adopt new products that not only help them on the electrification front, which is great, but that actually substitute very inefficient limestone that is out there with other binder systems that are more efficient and don't contain the embodied carbon. So map out your value chain, create vested interest at every part of that value chain, figure out who's going to push the rest of it, and then go execute.
Maybe related, maybe not, but I want to highlight, to my eye, the only kind of a positive result from COP29 was actually that the carbon credit market got somewhat more common grounds agreed. And that's something that helps then different type of industries potentially, you know, to convert and at least do something. I'd like to, from those interesting new value chains, new industries, I'd like to, the carbon, 23% or depending on, 33, 34% of the emissions are coming from the built environment and constructions, and you can then put the energy on different places. But I'd like to lift up also here the food kind of a value chain, and there is so much to do, and that goes even to our own plates and our own, habits. So I foresee that we could see there also kind of a systemic change happening where different players in the value chain, should they be rewarded and punished and measured like there will be now the digital product design. What is product? You France, you're doing this already. 1-2 years before the whole EU. What's the digital product pass? So these will help at least in the consumer or the traceability, that we could validate, be it more open, create the trust around these matters, that these sustainable value changes in value chains and value arenas truly will take place. And we need to be also, you as business decision makers, you need to ask, what has happened from cradle to grave or cradle to gate so far, when like how much emissions have been caused, has been created. And then, of course, the next one is biodiversity and nature laws. And then we're discussing about different quantums like laws of species, but that's another story.
Great, thanks a lot. I think time is up. So thanks everyone for being here, for your contribution.
Thank you.